What is trading on margin? Trading on margin is when you take out a loan to invest. This process is also called leveraging your position. Margin here basically means collateral. When you buy stocks on margin, the stocks are kept as collateral until you pay off your loan. This concept is similar to buying a house with a mortgage. The bank keeps the house as a collateral until you pay off the loan in full. How does it work? The first step to buying stocks on margin is to open a margin account, which differs from a traditional brokerage account. These accounts typically require a minimum balance and have varying levels of maintenance margin, interest rate, and other dynamics depending on the broker. The minimum balance is the initial account required to be deposited in a margin account before trading on margin or selling short. A maintenance margin is the minimum amount of equity that must be maintained in a margin account. In the 1920s, margin requirements were very loose, with brokers requiring investors to put up very little of their own money. Leverage rate of up to 90% weren't uncommon, which led to a high number of margin calls when the market fell, and eventually led to the 1929 crash. Since then, margin requirements have become more strict and regulated by the security industry. Brokers are required to obtain a signature to open a margin account. A minimum initial investment of $2,000 is required, and investors can only borrow up to 50% of the stock purchase price. Finally, the minimum required level of margin is 25% of the total market value of the securities in the margin account, and many brokers have higher maintenance requirement of 30 to 40%. A margin call is a brokerage demand that a margin account client deposits securities or cash into the account in order to bring the account balance up to the minimum maintenance margin requirement. We will illustrate a typical margin trading, its benefits and risks with an example of stock market. To make it simple, we will ignore the interest, tax, and the commissions for now. Suppose Professor Jackson purchased some shares in the old-fashioned way. If he buys 40 shares of $100 stocks for a total of $4,000, and the price per share increases to $120, he would earn $800, a 20% gain. Now assume that his broker offers that he purchased these shares with a margin requirement of 50%. He would therefore be able to purchase 4,000 worth of share with only 2,000 cash and borrow the additional 2,000 from his broker. When the share price increases to $120 a share, he will then earn $800 on his 2,000 out-of-pocket investment, or a gain of 40%. By using a margin, the profit is magnified when the market price goes up. But one must be careful when the market goes the opposite way, as the loss could be magnified as well. For example, suppose that after Professor Jackson purchased 40 shares for $4,000 without a margin, if the price dropped to $80 a share, he will lose $800 at a 20% loss. However, if he chooses to buy 4,000 shares on margin, he will also lose $800, but the loss will represent a loss of 40%. Things can go even worse if the price drops to less than 25% of the original value, which is the maintenance margin. It will trigger a margin call. He will have a very limited time to deposit more cash or to sell some of the shares to offset or a part of the difference between the actual stock price and the maintenance margin. If the investor does not fulfill a margin call, according to the signed agreement, the brokerage firm can sell the investor's securities without notification. The formula to get the share price that will trigger a margin call is initial share price times 1 minus initial margin divided by 1 minus maintenance margin. If we plug in the numbers from the above example, we get around $67 a share. So, if the price falls to $67 a share, Professor Jackson will receive a margin call. He will need to deposit extra cash to make the difference. In real cases, the prices of stocks may fall so dramatically and significantly that the loan cannot be repaid. This would never happen with traditional trading because the maximum loss is limited to the initial investment.